a lot of early stage founders and even sometimes even late stage think that they're worth like 10 times more than they are. So I don't know, like you'll see a lot of startups, I won't raise, anything below like 20 million evaluation, 100 million evaluation. I want like only 5% for investors or something like that. And that kind of causes a lot of friction. And I've seen actually deals fall apart because of these things. What's your recommendation when it comes to valuation and trying to understand and get a sensible valuation? And what are some of the kind of standards there? Because I didn't even know, what we should ask for. To me, it was like, I just want to build this. Let's try to figure out what's sensible. So what do you think? How should people approach that?
Yeah, Firstly, I think valuation can be a whole session in itself.
Of course.
So let's try to condense that as much as we can. At the very earliest stage, for example, when Vedran was raising or when you're raising your seed round of capital, not a lot of company building has yet happened. Not a lot of traction exists. So traditional sort of financial valuation metrics, for example, a revenue multiple or an EBITDA multiple, don't make any sense. There isn't anything to multiply with. So how should we come up with a valuation? So there is a lot of art, more art than science, to be honest. And it has to do with the new investor who wants to put in capital into the business, what kind of ownership requirements they might have. So this is like, what slice of the pie would they like to take? So when we started out, let's say Vedran had the whole pie. When we're coming in, what would Nauta like to take? So based on that, the valuation is kind of agreed. And of course, there's a negotiation. But broad parameters, that's probably how it works in the first, maybe even the second round. After that, once you start getting to more later stages and you have revenue to show, at that point, it starts making sense to have, you look at comparables, you look at other companies, how they're valued, you look at public market multiples. But before that, it wouldn't make a lot of sense. But again, I think a lot of founders may have in their opinion as well, right? We don't want to give away a lot of ownership. And I think that's a good mindset to have. You are building a company for the long term, and this won't be the only capital you take. So there have been many, many instances when by the time they've come to raise seed capital from a VC, they've done multiple rounds, perhaps, of friends and families and angels and convertible loan notes. And at the end, they don't know how much equity they've given up. You come to the seed round and we try to convert all of this debt and look at all the previous stuff. And perhaps 50% is left with the founders at the seed stage. How does that set you up when you need to raise a Series A, where again, maybe the investor is going to take 15, 20%, and then a B and a C. And hopefully you are trying to build a long-term company, which is going to require that capital.
So you said 15 to 20%. I think that's basically like, from my experience at seed and Series A, that's usually the number I've seen. And the number.
That's a broad,
Exactly. That's something that generally for seed stage, if you get 15%, you've done a really, really good job. And if you get more than 20, then maybe you could have negotiated better. But still, anything in that line makes sense. And I would say is reasonably fair because you guys are taking on a lot of risk yourself as well. But we've talked about many different scenarios where people wanted, like, they didn't even have a product and wanted 50 million valuations, et cetera, et cetera. So, and I think one of the earliest things that you've told me is like, think about the next round. Like if you get, let's say we wanted a 50 million valuation of Treble on the seed round, how much would we have had to make money-wise in order for somebody else to be able to say, okay, now this company is worth $200 million. What kind of a revenue would we have to get in order to get to that actual valuation? So it kind of makes sense.